Shares of Carmax getting wrecked. After reporting earnings and revenue that missed analyst estimates, the used vehicle retailer stock down almost 20%, hitting levels not seen since March 2020.
A $5.2 billion mistake just cost the Carmax CEO his job. America's largest used car retailer is now in crisis mode after a catastrophic miscalculation sent the company's stock plummeting 50% in just 9 months. William Nash, who led Carmax since 2016, was abruptly shown the exit door last week after the board of directors lost confidence in his ability to navigate what might be the most challenging period in the company's 40-year history. This wasn't just a minor setback or a bad quarter. This was a fundamental miscalculation about the direction of the entire used car market. A mistake so massive it wiped out over half of Carmax's market value and has industry analysts questioning whether the company can survive in its current form. The Richmond, Virginia-based auto retailer that revolutionized how Americans buy used cars is now fighting for its very existence. But here's what most people don't understand about this unfolding disaster. The seeds of Carmax's potential downfall weren't planted during the pandemic or even in the chaotic aftermath. They were sown in a series of decisions made throughout 2023 and 2024 that fundamentally misread where the market was heading. While competitors were cutting inventory and preserving cash, Carmax doubled down on a strategy that would prove catastrophically wrong. What exactly was the $5.2 billion mistake? How did a company once praised for its data-driven approach so drastically misread the market? And with Carmax's stock in freefall and a leadership vacuum at the top, is this truly the beginning of the end for America's largest used car retailer? That's what we're exposing today. The consequences of Carmax's strategic blunder extend far beyond just one company's balance sheet. With over 220 locations nationwide and 25,000 employees, Carmax's potential collapse would send shockwaves through the entire automotive retail landscape. For millions of American car buyers who've come to rely on Carmax's no-haggle pricing model, the company's downfall would fundamentally alter how used cars are bought and sold across the country. Let's dive into the catastrophic decision-making that led to this crisis, examine exactly where Carmax went wrong, and analyze whether there's any path forward for a company that once revolutionized an entire industry but now finds itself fighting for survival. The fatal bet that doomed Carmax. To understand the magnitude of Carmax's mistake, we need to look back to early 2024 when used car prices were showing the first signs of normalizing after the pandemic-driven price surge. Industry analysts were cautiously optimistic that the market was finally cooling, with the Manheim Used Vehicle Value Index posting 3 consecutive months of decline. Most dealers responded by carefully reducing inventory and preparing for what many expected to be a significant market correction. William Nash and his executive team saw things differently. Instead of following the cautious approach of competitors like AutoNation and Carvana, Carmax made a $5.2 billion bet that used car prices would remain elevated through at least mid-2025. The company dramatically increased its inventory purchases, acquiring nearly 45% more vehicles in the first half of 2024 compared to the same period in 2023. This massive inventory buildup was based on 2 critical assumptions, both of which would prove catastrophically wrong. First, that inflation and high interest rates would keep new car prices out of reach for most Americans, sustaining demand for used vehicles. Second, that the supply of 3 to 5-year-old vehicles, Carmax's sweet spot, would remain constrained due to the production shutdowns during the pandemic. Industry veteran and former AutoNation executive Mike Jackson didn't mince words when discussing Carmax's strategy. What Carmax did was essentially bet the company on a market forecast that contradicted virtually all available data. It wasn't just optimistic, it was delusional. They bought hundreds of thousands of vehicles at prices that made sense only if the market defied gravity indefinitely. The numbers are staggering. By June 2024, Carmax had accumulated an inventory of over 100,000 vehicles valued at approximately $5.2 billion, a historic high for the company. The average acquisition cost per vehicle was approaching $28,000, significantly above historical norms. Carmax was all in on a market that was about to collapse beneath them. What happened next was a lesson in market economics that will likely be studied in business schools for decades to come. Beginning in July 2024, used car values didn't just decline, they plummeted. The Manheim Used Vehicle Value Index recorded its steepest 5-month drop in history. With wholesale values falling 18% between July and November, retail prices followed, dropping an average of 21% by October. For Carmax, the timing couldn't have been worse. The company was now sitting on billions of dollars worth of inventory that was rapidly losing value with each passing week. By September, Carmax was selling vehicles at an average loss of $2,400 per unit compared to an average profit of $2,100 just 6 months earlier. A former Carmax regional manager who left the company in October described the internal panic. We were getting daily calls from corporate demanding that we move units regardless of profit margin. It quickly went from maintain our price integrity to get these cars off the lot at any cost. I've been in the auto business for 23 years and have never seen anything like it. The financial impact was immediate and severe. Carmax reported a quarterly loss of $812 million in November, its first quarterly loss since the 2008 financial crisis. The stock, which had been trading around $90 per share in January 2024, plunged to $45 by early December, wiping out over $4 billion in shareholder value. But the most shocking revelation came during the November earnings call, when Nash admitted that the company had continued its aggressive buying strategy even after seeing the first signs of market deterioration in July. "We believe the initial price drops were temporary and that the market would stabilize," Nash told stunned analysts. This admission effectively sealed his fate. 1 week later, Carmax's board announced Nash's immediate departure and the beginning of a search for new leadership. The interim CEO, Carmax CFO Enrique Mayer-Mora, inherited what one industry analyst called possibly the worst position any auto retail executive has faced in the past 20 years. The perfect storm. Why Carmax misread the market so badly. Carmax's catastrophic miscalculation wasn't just a simple forecasting error, it was a fundamental misreading of multiple market forces converging at once. And what makes this particularly shocking is that Carmax has built its entire business model around sophisticated data analytics and market forecasting. The first critical factor Carmax missed was the impact of improving new car supply. Throughout 2023, manufacturers had been gradually resolving the semiconductor shortages and supply chain disruptions that had constrained new vehicle production since the pandemic. By early 2024, new car inventory levels at dealerships nationwide had nearly returned to pre-pandemic levels. This surge in new car availability put immediate pressure on used car prices, particularly for late-model used vehicles that compete directly with new cars. Manufacturers, eager to regain market share after years of limited inventory, began offering increasingly aggressive incentives by mid-2024. The average new car incentive reached $3,800 by September 2024, nearly triple the average just 18 months earlier. J.D. Power automotive analyst Thomas King noted that the new car market recovered much faster than anyone anticipated. By June 2024, consumers suddenly had options they hadn't seen in years: plentiful inventory and meaningful discounts. This created a cascading effect through the entire used market that Carmax should have seen coming. The second major factor was the dramatic shift in interest rates. While Carmax correctly anticipated that the Federal Reserve would begin cutting rates in 2024, they severely underestimated both the timing and magnitude of these cuts. When the Fed implemented a surprise 50 basis point cut in July, followed by another 75-point cut in September, the impact on auto financing was immediate. Suddenly, new car loans became significantly more affordable, with average rates dropping from 7.8% in January to 6.3% by October. This rate reduction made the monthly payment on a $35,000 new car comparable to what buyers had been paying for $28,000 used cars just months earlier. The value proposition of late-model used cars, Carmax's primary inventory, collapsed almost overnight. The third factor was what industry insiders call the pandemic car bubble, finally bursting. During 2021 and 2022, millions of Americans purchased used vehicles at historically high prices due to new car shortages. By 2024, many of these cars were returning to the market as their owners sought to escape from underwater loans or trade up to newly available new cars. This flood of inventory created what Cox Automotive chief economist Jonathan Smoke called a perfect storm for companies like Carmax. You had increasing supply meeting decreasing demand at the exact moment when the financing environment shifted dramatically, Smoke explained. It was the worst possible combination for a company that had loaded up on inventory at peak prices. Perhaps most damning for Carmax was that competitors like Carvana and traditional dealership groups had correctly anticipated these trends and adjusted their strategies accordingly. Carvana had reduced its inventory by 25% between January and June 2024, focusing instead on profitability per unit. Traditional dealership groups had similarly adopted more conservative purchasing strategies, with many shifting their focus toward new cars as manufacturer incentives improved. Internal documents revealed during a recent shareholder lawsuit showed that Carmax's own data science team had actually forecasted a significant market correction beginning in Q3 2024. However, these warnings were apparently overruled by executive leadership, who believed their scale and market position would allow them to weather any downturn better than competitors. A former Carmax data scientist who left the company in August 2024 shared anonymously, "Our models were clearly showing a 15 to 20% price correction coming by September. We presented these findings to leadership in March, but they basically told us our models were too conservative. They were convinced that used car demand would remain strong regardless of what happened with new car supply." This dismissal of internal warnings represents perhaps the most troubling aspect of Carmax's failure. For a company that built its reputation on data-driven decision-making, the willingness to ignore clear signals from both internal and external sources suggests a level of executive hubris that ultimately cost shareholders billions and the CEO his job. The devastating financial impact, beyond the headline numbers. While the $5.2 billion inventory mistake has grabbed headlines, the true financial impact for Carmax extends far beyond just the declining value of their vehicle stock. The ripple effects through their business model have created what one financial analyst called a cascade of financial disasters. The most immediate problem is the inventory write-down. Accounting rules require Carmax to value their inventory at the lower of cost or market value. With market values plummeting, the company was forced to take a $3.1 billion write-down in their November financial statement, the largest in the company's history. But the inventory issue is just the beginning. Carmax's entire business model relies heavily on their ability to accurately predict vehicle values, not just for retail sales, but for their massive lending operation Carmax Auto Finance, CAF, which provides loans for approximately 40% of Carmax's retail customers, is now facing a severe crisis of its own. The portfolio of auto loans held by CAF was valued based on assumptions about vehicle values that no longer hold true. As used car prices have collapsed, the collateral backing these loans is now worth substantially less than anticipated. This has forced Carmax to increase their loan loss provisions by over $600 million, creating yet another drain on their already strained finances. Even more concerning is the impact on Carmax's securitization program. For years, Carmax has bundled its auto loans into securities that are sold to institutional investors. These securitizations depended on Carmax's historically accurate predictions of vehicle depreciation and loan performance. With those predictions now proving wildly inaccurate, the market for Carmax's loan-backed securities has essentially frozen. A banking analyst who specializes in auto loan securitizations explained the severity. The most recent Carmax securitization attempted in October couldn't find buyers even with significantly enhanced credit protections. That's unprecedented for a company of Carmax's size and suggests a complete loss of market confidence in their ability to value the underlying collateral. This securitization failure creates a dangerous feedback loop. Without the ability to securitize new loans, Carmax must either hold more loans on their own balance sheet, further straining their capital position, or reduce their lending activity, which would inevitably lead to fewer vehicle sales. The company's cash position has deteriorated rapidly as well. Carmax burned through $1.8 billion in cash during the third quarter of 2024 alone, reducing their available liquidity to the lowest level in over a decade. This cash burn has raised serious questions about the company's ability to meet its near-term obligations without raising additional capital. Credit rating agencies have taken notice, with both Moody's and S&P downgrading Carmax's debt to just one level above junk status in December. These downgrades have increased Carmax's borrowing costs at precisely the moment when they most need access to affordable capital. Continued. Perhaps most alarming is the company's debt maturity schedule. Carmax has approximately $1.6 billion in debt coming due in 2026. In normal circumstances, refinancing this debt would be routine, but with credit markets increasingly skeptical of Carmax's financial position and business model, refinancing may prove difficult or prohibitively expensive. Dan Ives, managing director at Wedbush Securities, didn't mince words in his December research note. Carmax is now fighting a multi-front war with dwindling ammunition. They're facing inventory losses, financing challenges, securitization freezes, and looming debt maturities all simultaneously. It's difficult to see how they navigate this perfect storm without significant structural changes to their business model. The financial pressure has already forced Carmax to take drastic measures. In December, the company announced plans to close 15 locations nationwide and reduce their workforce by approximately 3,000 employees, the first major layoffs in the company's history. These cost-cutting measures, while necessary, raise questions about Carmax's ability to maintain the customer experience that has differentiated them in the marketplace. For employees, shareholders, and customers alike, the financial deterioration has been shocking in both its speed and severity. A company that was reporting record profits just 18 months ago is now fighting for its financial survival, all because of a catastrophic misreading of market trends that should have been apparent to sophisticated industry participants. The leadership vacuum. Can anyone save Carmax? With William Nash's abrupt departure, Carmax now faces a critical leadership vacuum at precisely the moment when decisive action is most needed. Interim CEO Enrique Mayer-Mora, while experienced as the company's CFO, has never led a major retail organization, much less one in the midst of an existential crisis. The board's announcement that they've initiated a search for a permanent CEO has done little to reassure investors or employees. Industry insiders suggest that finding a qualified executive willing to take on such a challenging turnaround may prove difficult. Several retail analysts have noted that the most qualified candidates might be reluctant to tie their reputation to what could be an unwinnable situation. This is not a typical CEO search, explained retail executive recruiter Sandra Mitchell. You're asking someone to come into a company with severe inventory problems, financing challenges, and a potentially broken business model. The pool of executives with both the automotive experience and turnaround expertise to handle this situation is extremely small. The leadership challenges extend beyond just the CEO position. In the weeks following Nash's departure, several other senior executives have left the company, including the chief marketing officer and the executive vice president of store operations. These departures have created additional uncertainty throughout the organization at a time when clear direction is desperately needed. Former Carmax board member David Storch, who served on the board from 2017 to 2022, expressed concern about the current situation. The Carmax model works brilliantly in normal market conditions, but this environment is anything but normal. Whoever takes the helm will need to fundamentally rethink aspects of the business that have been sacrosanct for decades. The leadership vacuum has created a sense of paralysis throughout the organization, according to current employees. A store manager who requested anonymity described the current atmosphere. We're getting conflicting directions almost daily. One day we're told to focus on inventory reduction at any cost. The next day we're told to maintain margin integrity. Nobody seems to know what the actual strategy is anymore. This lack of clear direction is particularly problematic given the speed at which the used car market continues to evolve. While Carmax struggles with internal confusion, competitors are moving aggressively to capitalize on their weakness. Traditional dealership groups have expanded their used car operations, while online competitors like Carvana have launched targeted marketing campaigns specifically aimed at former Carmax customers. Perhaps most concerning for Carmax's future is the apparent loss of confidence from the manufacturer community. Multiple sources confirm that several major automakers have reduced or eliminated Carmax's access to their off-lease inventory, a critical source of the 3 to 5-year-old vehicles that have historically been Carmax's most profitable segment. An executive at one of the largest auto manufacturers, speaking on condition of anonymity, explained this decision. We're being more selective about our remarketing partners right now. With Carmax's financial situation unclear, we've made the decision to redirect much of our off-lease inventory to our own dealer network rather than wholesale channels. This loss of preferred access to manufacturer inventory creates a vicious cycle for Carmax. Without a steady supply of desirable late-model vehicles, the company will struggle to attract customers. Without customers, their already precarious financial situation will deteriorate further, making manufacturers even more reluctant to provide inventory. Breaking this cycle will require leadership that can simultaneously address the immediate inventory crisis while rebuilding confidence among manufacturers, lenders, investors, and customers. Whether such leadership can be found and whether they can implement changes quickly enough to save the company remains the central question facing Carmax today. Is there any path forward for Carmax? With Carmax's stock down 50%, billions in inventory losses, and a leadership vacuum at the top, many industry observers are openly questioning whether there's any viable path forward for what was once America's most successful used car retailer. The challenges are undeniably severe, but several potential scenarios could determine Carmax's future. The first and most straightforward path would be a traditional turnaround effort. This would involve aggressive inventory reduction, cost-cutting measures, store closures, and a fundamental rethinking of the company's inventory acquisition strategy. Some analysts believe Carmax could eventually return to profitability if they can right-size their operations and adapt their model to the new market reality. Wedbush analyst Michael Pachter outlined what this might look like. Carmax would need to reduce their footprint by approximately 25%, focus exclusively on their most profitable markets and vehicle segments, and completely overhaul their pricing algorithms. It would be painful and take at least 18 to 24 months, but there's a version of Carmax that could emerge as a smaller but sustainable business. The second potential path is a strategic acquisition or merger. Several large automotive retail groups have reportedly expressed interest in acquiring either the entire company or specific high-performing locations. AutoNation, Lithia Motors, and Penske Automotive Group have all been mentioned as potential acquirers, although none have publicly confirmed their interest. A merger would potentially allow Carmax to maintain much of their operational approach while benefiting from a stronger balance sheet and more diversified business model. Traditional dealer groups, which typically sell both new and used vehicles, have proven more resilient to market fluctuations precisely because of this diversification. The third and most radical path would be a complete business model transformation. Some industry innovators suggest that Carmax's most valuable asset isn't their inventory or even their store network. It's their brand recognition and customer database. This perspective opens the possibility of Carmax pivoting to a more capital-light marketplace model, similar to what Carvana attempted with their recent shift toward third-party listings. Former Tesla executive and automotive retail consultant Sarah Chin described this potential transformation. Carmax could leverage their brand and customer reach to become the trusted platform where private sellers and small dealers list their inventory. They could provide the verification, financing, and warranty services without taking on the inventory risk that's currently crushing them. Perhaps the most likely scenario, however, is some combination of these approaches. A new leadership team might implement aggressive cost-cutting and inventory reduction in the short term while simultaneously exploring strategic partnerships or business model innovations for the longer term. What seems increasingly clear is that the Carmax of the future, if there is to be one, will look very different from the company that revolutionized used car retailing in the 1990s and early 2000s. The no-haggle, high-inventory, data-driven model that served them so well for decades may simply no longer be viable in today's volatile automotive market. Industry veteran and dealer consultant Sheldon Miller put it bluntly: "The days of any single company maintaining a 200,000 vehicle inventory are over. The market is too volatile, the capital requirements too high, and the risks too great." Whatever emerges from this crisis, whether it's still called Carmax or something else entirely, will need to be fundamentally reimagined for today's reality. The Carmax legacy. Regardless of what happens next, whatever ultimately happens to Carmax as a company, their impact on the automotive retail landscape is undeniable. Prior to Carmax's founding in 1993, buying a used car was often an anxiety-inducing experience filled with high-pressure sales tactics, hidden fees, and questionable vehicle histories. Carmax fundamentally changed those expectations for an entire generation of American car buyers. The company pioneered innovations that are now industry standards: no-haggle pricing, detailed vehicle histories, comprehensive inspections, and return policies that gave consumers unprecedented confidence in used vehicle purchases. Even Carmax's fiercest competitors have adopted many of these consumer-friendly practices, recognizing that the expectations of car buyers have permanently evolved. Tom Dahl, former president of Subaru of America, acknowledged this lasting impact. Regardless of what happens to Carmax going forward, they've permanently changed how Americans expect to buy cars. The transparency and customer experience standards they established have become the baseline that everyone else must meet or exceed. This legacy extends beyond just the retail experience. Carmax also revolutionized the business systems behind used car retailing, developing sophisticated data analytics, inventory management practices, and pricing algorithms that transformed what had previously been an intuition-driven business into a data science operation. These approaches have been widely adopted throughout the industry. For consumers, perhaps the most significant aspect of Carmax's legacy is the demonstration that buying a used car doesn't have to be an adversarial experience. By eliminating the negotiation process and providing comprehensive vehicle information, Carmax created a model where consumers could make confident, informed decisions without the traditional dealer versus customer dynamic. Even if Carmax doesn't survive in its current form, these consumer expectations are unlikely to reverse. Any business model that emerges in the used car space, whether from traditional dealers, online platforms, or whatever entity might succeed Carmax, will need to address these expectations for transparency, convenience, and customer-friendly policies. The $5.2 billion inventory mistake that has brought Carmax to the brink may ultimately prove fatal for the company itself. But the revolution they started in how Americans buy and sell used cars will continue to shape the industry for decades to come. In our next video, we'll be examining the companies best positioned to fill the potential void left by Carmax's struggles, including which traditional dealer groups and online platforms are gaining market share in this rapidly evolving landscape. Until then, remember that in the automotive industry, as in any business, even the most successful companies must continually adapt to changing market conditions, or risk becoming cautionary tales like Carmax. If you found this information valuable, hit that subscribe button and share this video with anyone interested in the automotive industry or business strategy. Your support helps us continue bringing you the most in-depth analysis of the stories shaping today's automotive landscape.